Welcome back to Switzer. In recent times, a once loved stock, Isentia, has been slammed by the market, but this has been a stock that my colleague Roger Montgomery has told us that he likes. So, did the recent battering change his views on Isentia? And to find out, we have the man himself, Roger, at the desk. How are you?
I'm well, thanks, Peter. Nice to be here.
It's very rare that I have to ask you about a stock that you like that's really copped it.
Oh, well...
Occasion has happened, well, this one was an interesting one.
So what's happened is really interesting. So for 2 years there's been no growth in the banks and the resource companies, and so the big institutions have been looking for value amongst high quality mid-caps and to boost their returns. And then sentiment very quickly changed recently towards the banks and towards the resource companies, particularly BHP and Rio. And those big institutions found themselves underweight. So how do they get back to weight? They have to buy those stocks. How do they get the money to buy those stocks? They sell the mid-cap, high-quality stuff that they were in.
And the ones they've made money on as well?
Yes, indeed, the ones they've made money on. So you know, I'm often the criticism about our particular style of investing, which is high quality at cheap prices, is that high quality is never cheap. And right now, we've seen companies like APN Outdoor, REA, Car Sales, Healthscope, Isentia, which we're going to talk about in a minute, all of those companies down 35%, which is absolutely fantastic. Now, you know, I said it a few shows ago...
For you as a buyer...
Because we've got 30% cash in the fund, right? You might remember for the last 9 months we've said we couldn't find much value, so the cash was building up, and now we've got this opportunity to add to these things.
So you're buying them now?
We are, because the outlooks for the businesses in most cases haven't actually changed. So let's talk about Isentia. They bought a business...
Explain to the viewers what it does.
So Isentia is the old media monitors business. So they're a software as a service business, allowing companies to log on to a platform to monitor the media coverage about them, for example, and it offers analysis of that media coverage.
I guess that would be monitoring what we're saying about Isentia right now.
Right now, they will know what we've said. They will get a report tomorrow morning. They'll download it from the platform, and it'll have our show recorded, or your show rather, recorded, and us talking about this particular company. So that's one part of their business. Now, they've also got a value-added service part of the business, but let's put that to one side for a second. They bought a business called King Content, which is a content business. So the idea was that...
Local or foreign?
Local. And the idea is that they would be able to cross-sell this content. So a lot of media or ads don't work online. But content does. People read content and they're interested in that. So this company, King Content, was purchased for about $48 million, but over 5-year terms. So presumably they've only actually paid out maybe $20 million or $25 million.
What did you think of the purchase at the time?
Well, it was small compared to... our valuation of the business didn't include any King Content in there at all. So in the first half of 2017 financial year, that business, for which we think they've shelled out maybe $25 million, and they've still got another $23 million to spend if milestones are reached, and presumably they won't be reached because the business in the first half lost $2 million. Now here's the thing. So they've spent, I'm guessing, $20 or $25 million. They've lost $2 million. So even if they wrote the business off, they've lost $27 million. The market capitalisation of Isentia dropped by about $160 million.
It seems like a very...
It seems like an overreaction, doesn't it? So we're fortunate to be privy to a corporate briefing Shaw and Partners today had with John Kroll, the CEO. They had the Isentia CEO in there today, and they went through the detail of what went wrong, what they believe is going to happen next, and they also talked about their Australia-New Zealand strategy, which we've known about and we're very excited about. And all of that is still in place. This is a business that's generating 25 to 30% return on equity. The payout ratios are going to be about 50%. So, and their ARPU, so their average revenue per customer, or ARPC, is actually rising in Australia, even though it's a mature market. It's rising even faster in Asia, where not only do they have the ability to cross-sell, but they can sell the same product in multiple jurisdictions for the same company. So in Australia, you're Coca-Cola, for example, or one of the government departments, and you sell the program, and it might be $20,000 a year, and that's it. because it's Australia. You can sell 20,000 for Malaysia, you can sell 20,000 for Vietnam, you can sell 20,000. So you can sell multiple units of the same product to one customer because of the multiple jurisdictions. So we think the market has overreacted. We think the value is still higher. Our valuation includes nothing for King content, and they could write it off and it would all be back to thinking about the core business. So we're not concerned. The management has indicated that they believe they'll get the King content business back on track and it'll be profitable again.
So I guess the next important testing time will be reporting season.
Indeed.
And if they come out with a pretty good report,
I suspect that it will bounce.
Yeah, it will bounce.
You know, and there are other businesses which are in the same situation where the stock market has treated that which is temporary as permanent. And that's when value investors like us think it's absolutely Christmas.
Yeah. But you do have to talk to your investor supporters, don't you, in these sort of situations? Because a lot of times people don't understand that this is an opportunity where you actually will accumulate and the returns will show up either in 6 months' time or a year.
Well, if there's anyone who's been on your program that says lower prices are a good thing, it's been us. You know, when prices are going up and we're underperforming because we've got all this cash dragging out the performance of our portfolio, we want lower prices. The bigger issue, Peter, and something I wrote a white paper on, which I hope you don't mind me saying, it's completely educational. People can download it at montinvest.com/bonds. This is the big issue. Bond rates going up because in Australia, rates going up to 5%, there's a positive correlation between stock prices and bond prices. It's good for the stock market if bond rates go up to about 5% because that means the economy, and it means the economy is strengthening. But beyond 5%, and we suspect that the analysis is true also for the United States, beyond 5%, you'll start to see people care more about the lower present value of the future cash flows and a more attractive opportunity being in term deposits than the stock market, and then it becomes negative.
Yeah. So in many ways, because term deposits are so low now, people are always perusing stocks as an alternative. You're saying when bond rates and term deposits get around 5%, a lot of people say, well, why take a risk when you get a nice, safe 5%?
Correct. And history shows that the stock market does very well in the early stages of interest rate rises, and then it does worse after that. But we think there's two categories of stocks that we talk about in the white paper that we think investors are focusing on at the moment, which later will have problems, and at the moment they're well supported, and yet we've got all these high quality growth stocks that have been fallen by 30%, and no one wants to touch those, and we think now is the time to be thinking about rotating.
And you think these stocks that have been beaten up recently, and it's been like the top 20 stocks have benefited in recent times, they will come again?
They will come good because the market has overreacted and the results will be fine. And as rates go up, we'll find these companies with high debt and the companies with no growth, they'll be repriced down.
I made this point to a number of investors recently at a conference, that, and I'd be interested in your view, that if you're a long-term investor, when good quality companies do get beaten up and their price goes down, then it's not a bad time to buy them, as long as you've got time to wait.
Peter, this has been a crash. We have seen a crash in the quality end of the small cap and mid cap space. We divide the company up into 10 deciles of quality, and since the 1st of September, the very worst performing decile has been the highest quality stocks. And the best performing has been sort of the third or fourth worst quality companies.
Okay. Healthscope was one that's cropped it. Is this a good company that could make a comeback? We're
doing more work on it. We've added to our holding. We're continuing to work on it. The company said that its quarterly admission numbers showed unusual volatility. In other words, they were a bit soft. The company went on to say that if that continues for another 9 months, then EBIT won't grow, and the market was expecting growth of about 10%. So the share price dropped 27% in a couple of days. But if you look at the last 5 years, there's been plenty of volatility, but the trend is up. If you look at the last 20 years, there's been plenty of volatility, but the trend is even steeper. The biggest admission cohort, the biggest contributor to admissions of elective surgery in private hospitals in Australia, the 65 to 74-year-old group and the 85-plus-year-old group, which happen to be the fastest growing two groups in the Australian population.
One quick one before we go. you never were a fan of BHP when it was up $20, $30.
Or $40.
Yeah, but when it got to 14, were you tempted?
No, not at all, because we think the price is going. The iron ore price will inevitably bounce from low levels, but the supply response will be even quicker this time because it's not going to take years to develop the mines, and it won't employ as many people, so it also won't be as good for Australia.
So you're tipping that BHP share price will eventually come off the boil again, and the companies that you're talking about will be the ones that will be chased.
BHP has 3 times as much equity as it had 10 years ago, 3 times as much debt as it had 10 years ago, and its profits are lower than it was 10 years ago. So we don't think that's a great business.
So you clearly have not forgiven BHP. Roger Montgomery, thanks for joining us on the show. That's the show.